right, guys, welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins-Hutton, the Director of Investor Education here at PassiveInvesting.com. With us today, we have a special guest, Josh Ferarri. Josh, welcome to the podcast.
Well, thanks for having me. I didn't realize I was so special.
Well, everybody's special, right? Because you have amazing information you're going to impart to our guests on how you acquired, your most recent asset, or one of your most recent assets. But before we dive into the details of Riverside Apartments, 118-unit multifamily in Biloxi, Mississippi, please talk to us about yourself, like your background and what got you into the multifamily space.
Oh yeah, the age-old question: who's Josh Ferarri? Well, I was initially an aircraft technician. So back before I got started in this business, I went to college to become an aircraft technician, and then got my first job here in Southern Alabama. Moved from Memphis, Tennessee down here to start what I thought was going to be a long-standing career. And then my dad was getting ready to retire after 30 years in the Navy and wasn't really ready to retire, right? He's like, I'm not ready to just sit around and do nothing. I'm in my prime working years, is what he told me. So he calls me up one random day, a little over 5 years ago in January of 2018, and tells me that him and my mom are getting ready to start flipping houses. He's all excited about it. He's telling me all the great things, and they're about to go through this course mastermind thing, and they're going to get all these credit cards, and they're going to get to buy the house for free. And then the house is going to pay for itself plus money made on top. And I'm like, what are you talking about? I was so lost and confused, but it was interesting, right? It was an interesting convo to hear you can buy a piece of real estate for free. So at the end of that conversation, that really kind of catapulted me into the business. And almost immediately thereafter, my wife and I jumped into wholesaling. We were like, all right, we're going to try something. We're going to try something small. And maybe, just maybe, we can be a little successful, make a little bit of money, get a little bit of experience, and ultimately grow our portfolio that way. Well, 6 months goes by. We didn't close any deals. We're like, all right, this is not necessarily something that I feel like I want to do long term. Not really looking to build a wholesaling empire. We knew we just wanted the benefits of owning real estate. So we pivoted and reaverted our focus to owning. So we bought a fourplex, and we thought we were going to just do the house hacking thing forever. Just always just another house hack, another house hack, another house hack, until we got to whatever point we thought we were going to. We didn't really have a lot of clarity, if anyone hasn't noticed yet. We were just kind of bouncing around. So then a couple of years go by, 2.5 years to be exact, and we lose $60,000 on that first ever actual investment. So we learned a lot of valuable lessons, I will say, throughout that time frame. We learned some even early on before actually going full cycle on the deal. And one of them was just that we didn't really understand what we wanted out of life. True lifestyle. What are we trying to build? What does that look like? I have no idea. But we knew that, excuse me, we knew we had to get clarity, because the direction we were headed in, I was working 100-hour work weeks with the day job and fixing the fourplex. I'm newlyweds, can't even see my wife. We can't hang out, no dates, broke as a joke. This is not, and you look on social media and you see everyone else our age, going to Asia and Italy and going on these amazing vacations and buying homes and starting families. And I'm like, we can't afford to start a family. We can't afford to buy a home. We can't afford to go on vacations. And I don't have time to do any of those things either. I'm like, this is miserable. Who wants this? So once we got clarity on the life we wanted to live, I was like, all right, now we have to build a business around that. So that was when we made the decision that larger scale multifamily, specifically syndications, is going to be what got us there. And that was about 4 years ago. So kind of in that first third phase, if you could break up the fourplex into 3 phases, the first third phase of the fourplex, we quickly realized this was not going to work. So fast forward about 2 years after making the decision that multifamily is what we wanted to do, and I found a mentor right away. It's all right, not going to waste time like I did with the fourplex and the wholesaling and just churn my wheels, waste time and money. I don't have time and money to waste. So found a mentor that could really help accelerate my growth into the business. And also found my 2 business partners in that same kind of 2-year stint. And it's just 2 years solid of focus and trying and analyzing deal after deal after deal. And nothing's going through, can't close nothing. And brokers aren't taking you seriously, and just the whole thing. So then a little over 2 years ago, just barely 2 years ago, was we actually closed our first deal, which was a 42 unit here locally in Southern Alabama. And just in the last 2 years, we've closed over 768 units, 62 million assets under management. We have another 106 under contract. We'll be closing in February. I've personally raised over $25 million from various passive investors over the last 2 years. We now have 2 employees, so we're starting to grow vertically. That's fun. Employee hiring is, man, the training and onboarding is definitely taking more time than I initially anticipated. But that's a conversation for another time, right? And then I started a podcast also for those of you out there listening to this that really enjoy podcasts. You can go check me out at Creative Capital. And that podcast has done phenomenal. And I've been able to meet so many incredible people. It's definitely helped us raise a lot more money and be taken seriously and just meet. Like, I'm pretty sure I had Dan Hanford on my show. I just had Brandon Turner on my show, like first billionaire I've ever had a face-to-face conversation with. And I'm about to have Grant Cardone. So it's been a blast. I was officially able to go full-time in my actual real estate investing business about 6 months ago after 18 months of actually closing deals. And then June of last year in 2022, I actually started a mastermind to help other people do the same. And since then, we've had 24 people join, and they've closed 7 deals, 410 units, $40 million assets under management, and they've raised over $33 million, all as new investors in a 6-month time frame. So that's a little bit about me.
That's amazing, even in the middle of this kind of choppy water environment. Well, let's stay, people listening here want to focus on the asset. So let's dive into the details. You ready?
Ready.
Awesome. Okay, so we've got Riverside Apartments, 118 units, multifamily in Biloxi, Mississippi. So let's talk about, when did you acquire this? And then walk me through, like, how did you actually find the deal?
We acquired it back, like our actual closing date was November of 2022. So literally like 3 months ago. And the way that we found it actually was kind of interesting. So we had a broker come to us with a deal that was in that same similar Biloxi, Pascagoula area, which we own another 400 or some odd units in that area. So it was a market we already like, and he knew that. And so when this deal came about, he reached out to us and said, "Hey, I got this deal. I think you guys are really going to like it. Why don't you come do a tour with me? I'll be in town, next week," or whenever the time was. We're like, "All right, sure. Sounds great." So we go and do the tour. We like
When
it.
was this in relation to the close? Was this in summer?
This was 3 months prior. So this was not, I don't know. I'm horrible at like quick math in my head. That's October, September, August-ish.
Okay.
I guess it would have been before August because we had 3 months to like close the deal. So it would have been like July. Yeah.
Okay.
Would have been July timeframe. So we tour this property and we like the asset. We put an offer on it. And then he takes the offer and gives it to the seller. And then the seller has to take it to his partner. So, I mean, I don't really know what the relationship or communication was with the sellers. We're just communicating with the broker, but apparently the broker had been in contact with just 1 out of 2 of the sellers. And so the one seller was all about selling this deal. And he was the one that contacted the broker and was like, "Let's do it. Let's make it happen." And we like it. We actually submit an offer. And then when the one seller goes to his partner's like, "Absolutely not. We're never selling this deal." And we were like, "Okay, what a big waste of time." Then the broker looks like an idiot because he's wasted his time and we've all gone out there and walked it. And yeah, it was this whole thing. But then the one partner, the one seller that initially contacted the broker, he felt bad, naturally, because I guess he just felt the need that he could sell assets without talking to his partner. I don't know what happened. Anyway, they had another deal, which was Riverside, that they were like, "Well, we do actually have another asset that I've talked to my business partner this time, and we would be interested in selling. So why don't you guys go take a look at that?" So we actually were the one and only set of eyeballs that got to look at this deal, which was really cool. So we put an offer in on that one deal, didn't pan out because they weren't selling it. So then we go over to this Riverside deal and we're like, I feel like I like this deal better. So it kind of ended up being an interesting win-win. We put an offer on that and basically got it under contract immediately. There was a little bit of back and forth negotiations, but got it under contract at, I believe, 12.8 million, which was, I can't do that quick math in my head, whatever that is on a per door basis, 118 units. which was a pretty good basis for an asset in this particular area. We were used to buying deals a little lesser price per door than what we just paid for this one, or what we planned on paying for this one.
108 is what I'm calculating.
108 a door.
Yep.
Okay. Yeah. So we were used to paying something closer to like 50 a door, but most of our portfolio was like B and C class. This property was an A class asset. So it was our first and ever A class property that we were considering acquiring. And it was kind of exciting, you know, because you get everyone's likes the big shiny new object, right? It's built in 2013. Everything's brand new. There's not much CapEx required. And so a lot of people think, oh, well, there's not a lot of value added if that's the case. But there actually was
What was your overarching business plan with this?
A very unique value add to this deal. Well, I'll tell you. So the value add, basically, this property was a 55 plus community. And it was built on a state grant where the builder was given a grant from the state to, it was like some tax incentives and then the actual grant money to build it. And the only reason they were willing to do that is, you know, through the contract that they had. It wasn't like LIHTC. It wasn't any like federal thing. It was just state level, which I had never seen before. It was very interesting to us. We learned a lot. But the grant stated that it had to be a 55 plus community for at least the next 10 years. So it was like a 10-year grant. And then also, through it being a 55 plus community, the rents had to be subsidized at a certain level. So they had to be, you could only go so high on what you can charge for rent, and you had to keep it 55 plus. So the builder, I guess, got all of his tax benefits and his whatever, he got all his benefits out of what he needed it, or the owner after having it for 10 years. And so then when we acquired it, you know, we acquired it in November of last year, and it was built in 2013. So summer of this year, 2023, the grant will be over with, and we'll be able to take all the rents from where they are today to market rate, which there is a $500 a month delta between where they are today to where market is. So we literally have to do no work at all. It's just a big loss to lease play because it's a brand new property. And bam, as long as we just know what we're doing with management and we get this property turned around, then there is a massive value add that's going to allow us to be able to return 100% of our investors' initial capital back by the third year. And then we will do what we call cash flowing in perpetuity. So our holds for these assets are typically about 20 to 30 years. We don't like the quick flip stuff.
All right, so much to unpack here. So, okay, first of all, I understand the business plan. That's amazing. But there's a whole story about before this, like with due diligence and everything, that you had to kind of dig through. But I want to understand, because we were bantering a little bit before the show. Were you the sole owner on this, or did you have partners?
Definitely had partners. So it's me and my two business partners. We've done every deal that we've ever done. That my whole portfolio, I was just telling you guys. Every deal I've ever done, the three of us have done it together. Now, this particular deal, we also brought in a KP because it was one of the larger deals that we've ever done. So we had the KP come in, help us raise a little cash, help us with the management too, because the KP has their own big operating syndication business. So interestingly enough, we're actually also starting our own property management company with this deal. And this is kind of like our trial deal of having in-house property management and beginning to vertically integrate. And that's been another whirlwind, but
of course,
yes, partners, always partners. Every deal I've ever done, the three of us, and most of the deals that we do, it's just the three of us. But this deal, we brought in the KP.
Okay, so how did you structure the deal between the three of you?
Like who does what? What do you mean?
Yeah, like how do you structure the partnership here?
So I am investor relations. I handle the majority of the capital raising. I handle webinar creation. I handle pitch decks. I handle the investor portal questions, right? From new investors wanting to come in and wanting to know more about the deal. So I have to be deeply in tune with how this deal is going to be structured and how the financial payouts are actually going to perform and why they're going to perform that way. Tell me about the insurance. Like I have to know a lot about the asset to be able to take the barrage of questions that I get from investors. So I handle all that ongoing communications and investor relations with deals that we already have going and K1s and distributions, all that stuff. That's me. So Reggie He handles all of the asset management. So he does a lot of the on-site visits and budgets and monthly reviews and quarterly reviews and making sure that we're on track. And we have a professional bookkeeper that we have actually keep the books on all our assets, but then he's like the last set of eyes for bookkeeping. We call him our forensic accountant. And then after he looks at everything, he kind of like green lights it all. And then that's what we use for distributions or for anything else. So he does that as well. And he's also helping a lot with the PM for this property since we're starting our own PM company. So he's helping a lot with that onboarding process and what that looks like. So he does a lot of the day-to-day basically. Then Matt is, interestingly enough, I feel like we should call it Reggie operations, but we call Matt operations. And Matt he doesn't do the day-to-day. He handles, he helps with capital raising as well. So it's primarily me, call it 80% of the way, and then Matt handles the last 20% for raising cash with the network that he has. And then he also was our money guy initially. So we ended up having to bring a KP into this one because the deal was bigger than he could handle. But initially, for a lot of the other deals that we've done, he's kind of been the KP. He's the one with the net worth and the liquidity that helps actually like get the deal across the finish line. But recently, here in the last couple 6 or so odd months, we've kind of built our business account, our actual entity account, which is 3 Beach Capital. And we built that to basically fund everything that we need. So now he also helps a lot with underwriting. So we like to say that I'm the optimist, Reggie's the realist, and Matt's the pessimist. So if Matt can't kill the deal, it's probably a pretty good deal. That's how we usually like to look at it. So he helps a lot with the underwriting, both preliminary and the deeper dives. And he also, in his day job, he's an agent. He's an agent in Tampa, Florida. So he has a whole team of people and employees around him that help him with the single family agent side of the business. So some of the assistants and stuff that he has doing that, they also kind of flow and funnel through into our multifamily side of the business and help us with some of those admin tasks.
Well, I want to get into actually here in a bit and to the splits, the capital stack and the waterfall, because, we were talking about how you actually had to raise capital for this particular deal. But you mentioned due diligence. Talk to me specifically about this deal, the due diligence process that you guys went through. When did you visit the property? During your due diligence phase, were there any surprises? How did you handle them? Also, when did you have to put down hard money in order to keep the deal secure?
So this was kind of in a pivoting point, right? This was about August timeframe of last year when the market was shifting and it was slowly starting to become a little bit more of a buyer's market. So we didn't have to put down hard money immediately. We did the standard, like money goes hard after due diligence. So we had like 60 days for due diligence on this deal and then 30 days to close thereafter. So money went hard after 60 days. We had plenty of time to do all the looking and stuff that we needed to do to make sure that this was a deal we wanted to pursue. As far as due diligence, we walked it initially, right? We had the chance to walk it with the broker before we put the offer on it.
Did you walk every unit or just part of the unit?
Typically our initial walks, we only get to see like a model unit. Like you don't really get to walk in any units the tenants live in. And then we just really look at the exterior, drive the surrounding area, talk to the PM. There's some things we get to do preliminarily, but it's like, you're not under LOI, you're not under contract. I'm not letting you in my units. It's like, I understand. I'd be the same way if it was my deal. So then after we actually got it under contract, then we like to visit it as soon as possible. So probably about 2 weeks, maybe after we actually got it under contract, we had a time scheduled to get out there and get our third-party inspection company out there. So the 3 of us are never going to have enough time or be able to pay attention to every little thing on 118 units. Like, it's just not our area of expertise. We're good at due diligence, I guess, kind of, but looking at every little thing and the dates and like appliances and like crawling into air ducts and seeing if there's like mold in them. Like, I'm not going to do all that when I'm doing my walkthrough when I go to the property. I'm looking for different things that I see that, my area of expertise notices that we need to make sure we fix. Same thing with Matt, same thing with Reggie. And then we have the third-party inspection company that does the majority of like the real deep, detailed minutia and that actually puts together the due diligence kind of like packet. of all their findings. So we had about 5 guys or so that the company brought out with them to actually walk every single property, look at every single thing, roofs, crawling up on the roofs, all that good stuff. So we got to walk a handful of units. We don't usually walk every property, but the inspection company does. We usually walk 2 or 3 of each like unit mix. So like if there's 3 2s, we like to walk 2 or 3 of those. 2 2s, we like to walk 2 or 3 of those. And I like to walk them in different buildings. So I like to see like where they're facing, is one building more dilapidated than the next one for these kinds of unit mix? Is this one more desirable because they took the time to renovate this one? They haven't renovated this one. Now, this property was Class A, so we didn't have a lot of those problems, but we still walked all the units anyway. Of course, like to look at all the amenities and interview the property managers, make sure that the property manager was someone that we wanted to keep. And of course, we decided not to keep the property management company, but we decided to keep 1 or 2 of the employees, which we then came in as the primary company, hired them as basically on now our payroll. And now it's our company with our systems and our structure and, all that good stuff. So as far as due diligence, we didn't really find anything out of the ordinary because it was Class A. So that was what was really also really nice about this property is like we did all the due diligence we normally do for older assets to see if there's anything hidden, but everything on this property was pretty well put together, which was very nice. And also super exciting. We were just like, heck yeah, Class A property. I can't believe we're getting Class A and there's still a value add, right?
Well, talk to me about the financial part of the due diligence, because I feel like that's where we're transitioning to next, right? So walk me through how you underwrote the property and, verified everything, all these different, government programs, because that seems really unique. And then also compiled your projections going forward.
So Reggie did all of the like government program information, detailed deep dive. He was calling the state and asking questions and looking at the contract and confirming stuff and making sure that it actually did end in August. And once it ends, there's not like some cool down period or some time frame that we have to like follow some regulation or law. It was quite literally that at the time frame that the contract ended, that was it. It was over with. We could do whatever we wanted with the property. We could keep it a 55 plus. We could not keep it a 55 plus. Now we'll probably end up keeping it a 55 plus because it's already built for that. Like, get this, there's literally a library. Kid you not, a library. And at 2013 build, people are still building libraries. But old people seem to like libraries and books. So there is a whole library structure. I'm talking like at least a couple, like 7,000 square foot library of just, there's like 2 massive bookshelves on either side of the wall full of books, and then all this comfy seating and rocking chairs and recliners and stuff where people can chill and read. And I'm like, this is hilarious. If we were to turn this into a younger generation kind of property, then I could see this never getting used, or this being like not necessarily a turnoff, but like people would look at this and be like, wow, I'm never using this. But maybe they would. I don't know. Maybe they'd use it as like an office. But we'll probably end up keeping it 55 plus. So he was doing all the financial detailed data and outlook on that. We also have the company that we hire to do the on-site like inspection. They also do a lease audit and they kind of do the financial audit for us as well. Now we usually go back and double check just to be sure. We don't do everything that they do, but we check a lot of what they've done and confirming leases being the same, like this is what's on the lease versus this is what was on the rent roll that they gave us. Like, is it legit? Is this the same person that they're saying? Did they actually pay? So we had the third party inspection company do a lot of that. Then we kind of went back and back checked that. But as far as the actual like financial projections, I think that's the exciting part that everyone loves about real estate, right? So as far as financial projections for this deal, basically, I guess the best way to do it is to give an investor example. So like an investor comes in with $100,000 and what happens? So investor invests 100 grand in this deal. They're going to get well, actually, it depends on the share class. We ended up separating this into 2 separate share classes. So if we have what we call cash flow shares and legacy shares. Our cash flow share is what most people call the Class A share. It's like pref equity. So you come in and you get a 10% preferred return. You get that every year, year over year for 3 years, at which point in year 3, after we've implemented and executed on the business plan, that's when we do the cash out refinance, return 100% of their initial investment back, and then they're out of the deal. So the great thing we like about pref equity, as opposed to like a debt position, is they actually get to benefit in the equity for the 3 years that they're in the deal. So they still get all the tax benefits and everything, which they thoroughly enjoyed, and they were able to get their 10% return, which just allowed us to be able to raise the money that much more easily, right? People are like, oh, I get all those benefits and I get 10%. Like, shoot, yeah, I'm in. So that was Class A, or cash flow shares, what we were calling it. Then Class B, or legacy share, because I think I had mentioned briefly, we really like the perpetuity model, is what we've called it and coined the term, so to say. And it's just really just a longer term hold. It's about 20 to 30 years. And we kind of structure it a little bit differently than just like a standard long-term syndication hold. So that class of share would come in with $100,000. They would get a 6% preferred return instead. They would get that year over year for 3 years. And then at the end of the 3rd year, they too, through the same refinance, would get all of their capital back. But once they get all their capital back, they actually don't get kicked out of the deal. They get to stay in the deal. So the benefit for them is that they now have immediately doubled their equity overnight, because we did basically a 50-50 split down the middle between the 2 shares. So those other 50% of investors that got paid off and now they're out of the deal, all that equity gets sent over to the guys that were Class B. And now that they've doubled their equity, they have more depreciation, more tax benefits, and they didn't have to invest any additional cash. They just had to be willing to take lesser of a pref in the early phases in order to benefit in the long haul. So they're going to be with us in the long haul over the next 20 to 30 years, as long as we hold on to the asset. They will remain in the deal. And they will continue to cash flow the entire time. Now, the only thing that shifts, the only thing that changes is at year 3, once the investors get 100% of their cash back, both share classes, then the cash flow, not the equity, cash flow inverts. So when I say equity remains the same, I mean anything on paper. So their K1s is still going to show that they own the same pro rata share of equity that they initially bought in, until those other investors get bought out, and then they're going to suddenly own double. So they're going to get the same depreciation tax benefits and net worth, if that's important to them. Their net worth is going to be the same, and then it's going to double when they get more equity. The only thing that shifts is cash flow. So any actual cash put off by the property, both monthly and quarterly cash flow and distributions, as well as any refi in the future, and ultimately at the sale, 20 to some odd years when we decide to sell, we as the GPs then receive 70% of the cash flow for life, and they receive 30% of the cash flow for life. So it's an initial 70-30 split when they buy in, and then we just invert it once they get all their money back. So that's how we actually financially structured this deal.
Oh, interesting. So, just if you can summate, like, what was the capital stack? Like, what did it look like? How much did your KP bring? How much, or if anything? And then how much did the investors bring? And then how much did you secure for lending?
So we collectively, let's see, this is definitely not my area of expertise. I'm gonna try to remember as best I can. So if it was 12.8 as the purchase price, we did a 65% LTV on that. So whatever number that equates to, you know what that is off the top of your head?
Not off the top of my head, but I got a trusty little calculator right here. So
exactly, I'm the same way.
So 65%, that is 8,320,000.
Okay, so just call it 8.3. So
Yep.
Let me write that down. So that leaves 12.8 minus 8.
So that you raised 4.5 from investors.
Okay, so I got the number in front of me now. All right, so we had that as our primary loan that we got. And the loan that we got, we actually went through a local bank. We were able to get even in, because we got the loan like locked in around September timeframe. And we were able to get a 5.2% interest rate. So I know things are at like 7% or something now. So we got a pretty good deal, able to go with the local bank, which we've done a lot of our deals with actually. And it was able to be fixed rate. So we're not on this floating thing. We're not buying rate caps. We're not worried about any of that. We wanted to get not super long-term debt, because we know we're going to want to refi in the next couple of years, but we wanted to get something a little more long-term. So this actually has a 5-year life cycle on it. But it is fixed rate, and there's no prepayment penalties, no yield maintenance, none of that stuff. So very beneficial for us. We loved it. We moved forward. And we wanted to do 65% loan to value instead of the regular like 70% that we were doing, just to try to add that additional elimination of risk with where the market is and what's going on. We wanted to make sure we just had a little extra equity to put ourselves in a good spot, and our investors, of course. So the actual capital that we raised ended up being 5.6. So 4.5 was left for the actual purchase price. And then we raised an extra million, I guess that'd be 1.1 million for working capital, reserves, any additional CapEx, which of course there wasn't much as Class A, but wanted it there anyway. So we just like to have enough cash on hand always to make sure that we are positioning ourselves properly to do what's needed to be done. Now, on top of that, that capital also included closing costs, and that capital also included our acquisition fee. We charged a 2% acquisition fee on that one. So there were some other fees in there. But all of that stuff was included in the total raise of the 5.6. And we personally on the GP team brought a little over $1 million towards the closing for the equity, because we really liked this deal. We're like, this is freaking amazing. So we invested about $1 million into it alongside our investors. I think that basically makes up the capital stack.
Awesome. And then, you mentioned the acquisition fee. Like, do you guys on this particular one charge an asset management fee or any like disposition fees?
So we never do any disposition or what we call capital transaction fees, any kind of fee you would get on a refi or a sale. But we did do an asset management fee. We usually do about 2%. That's what we did for this one. And same thing. And it's 2% of like gross monthly collected rents. And then same thing for the acquisition fee. We usually charge 2% of the purchase price.
Okay.
So those are the only actual fees we charged. And then we try to align our interest with our investors by structuring it in such a way that they have to get all their money back and all their risk has to be eliminated before we get our massive payday, which is that 70% cash flow swap.
The flip of the split. So, walk me through the partnership, structure. So you have that 30% that is for the general partnership. How did you, share what you are comfortable sharing, but how did you guys, divvy that up amongst the three partners, but also with the key partner?
So with the three of us, we basically do everything as a three-way split. So our ownership percentage is just split can't say down the middle, three ways. Between the three of us. And the KP came in and got about 10% equity for signing on the loan. So we total had 90% equity of 30%, whatever that equates to, and then split that by 3. And that was our equity structure layout for this deal.
Okay, interesting. Okay, very cool. So just wrapping up, were there any other issues that came up through due diligence or the closing at all?
Not for this deal. For this deal, everything was fairly streamlined, and we thoroughly enjoyed going through the process. The broker was great, sellers were great, even though they were kind of weird in the beginning. And we raised the capital fairly quickly too. We felt like it was such a great opportunity. Class A, everyone was super excited that it was Class A, and this really eliminates a lot of risk, and we were able to go lower LTV and raise more capital and more equity for additional reserves, and we were still able to provide the same returns we usually do to our investors. So there was a lot of meat on the bone on this one, and we raised 5.6 million in like 3 weeks.
Oh, very cool. Very cool.
So
that kind of like dovetails into my other question, and apologize for cutting you off, but I don't want you to get put the cart before the horse here, because I also want to dive into, was there anything that you found was easier during the process that you thought was going to be more challenging? And then also flipping it around, did you find anything that was more challenging that you honestly thought was going to be easier?
Interesting question. Easier that I thought was going to be more challenging. Capital raise. So capital raise is usually something that I don't necessarily think is going to be like super difficult, but I'm always like, this is one of the larger raises we've ever done. So I'm always like, oh, we're like pushing the boundaries of how much cash we can raise. It's like, well, we've never done this before, but we're going to try it. Let's see how much cash we can raise. And then it always surprises me what we're able to do. So I would say that as far as the first one. And the second one, what was more difficult that I thought was going to be easier? For this deal, I guess I would have to say what Reggie had to go through with the state, like conversations about the grant and figuring all that stuff out. And then, I'll say another thing, the property management company. That's a good answer. Not that I thought it was going to be easy by any means, but it's been a lot more challenging than initially anticipated to get up and running your own PM company, even though this is kind of like the one time, like one off, just trying it, seeing how it works, seeing how it functions. If we really like it, we'll end up going widespread and creating a company for our entire portfolio. But that's definitely been a little bit more difficult than I probably would have initially anticipated.
Mm. Well, this sounds like an amazing deal, and you guys definitely put in the hard work up front to create the value add, right? The adage is you always make money on the buy, and it sounds like all of that work that, one, the relationship work that you did in maintaining the relationship with, like, not only the broker but with the seller to get kind of pitched an off-market deal. That you were the only set of eyes on. That's, a lot of people kind of give up on that one. They probably would have walked away from that broker relationship and never even got the opportunity. But two, just, creating that value add with, beginning to understand, the complexity of that contract that was on the property, how it was originally positioned, and then, having the foresight to model how to take it to its next higher and best use. So, kudos to you guys. And also, just thank you so much for sharing your experience today. If listeners want to know more about you, reach out to you and follow you, what's the best way they can get a hold of you?
The best way to get a hold of me, if you are a passive investor looking to learn more about what it is that we do, you can go to 3beach.com, spelled out THREEBEACH.com. And that's the best website for all of our passive people. And if you're an active investor out there listening to this and you're like, well, I want to learn how to do what you did, well, go to ferraricapital.com. That's the website for all the active investors with the podcasts and all the other stuff's on there.
Awesome. Well, Josh, thank you for spending your time here with us today and sharing your knowledge. We look forward to following your deal and perhaps having you back on a future podcast.
Yeah, I appreciate you having me. It was fun.